Mr. Chairman. My name is Han Chung-young, professor at Chungang University, Graduate School of International Studies. I'm so delighted to moderate this prestigious breakfast lecture sponsored by the Institute for Global Economics. When I was asked by President Lee Young-tak to serve as moderator, I accepted gladly the invitation because I really wanted to know when Korean economy will bottom out. For that matter, how soon the United States from the ongoing global financial tsunami and subsequent global economic downturn, how long the recession will last in Korea and the US. During the Asian financial crisis that erupted just 11 years ago, international literature described Korea as an IMF reform model. Indeed, the IMF stringent conditionality to draw the largest ever IMF bailout program, we thought Korea had gone through a painful restructuring process for major sectors, namely banking, corporate, public enterprise, and labor sectors. Then in 1998, Korea surprised the world by registering the record trade surplus amounting to $41.5 billion due to a robust external economic environment. And Korea was able to graduate from the IMF program far sooner than expected. This time, however, the picture is the other way around. Most commentators evaluated Korean economy and used a strong economic fundamentals, such as the 6th largest foreign exchange reserve in the world, amounting to $240 billion at the end of September this year. And also a lot improved the debt to equity ratio of Korea's corporate sectors. And also relatively very sound banking sector, having the BIS ratio at the global standard. However, in the past 3 months, 2 or 4 months, most Koreans have been a total loss. After seeing that at least 1/2 of our financial asset value evaporated into air, including myself. But furthermore, we are not sure whether the worst has yet to come next year, as we see the 3D symptoms: deleverage, deflation, and default are increasingly becoming a harsh reality in Korea. What would be the best serving policy package for Korea? How can we make sure that $1 exchange rate would return to normal equilibrium level, ending the rampant surge with extreme volatility? Under the Obama administration in the US, the proposed New Deal could be effective without really knowing the depths and magnitude of non-performing assets originated from the subprime mortgage. Well, endless questions and issues keep emerging. This morning, we are so fortunate that we have a prominent speaker, Dr. Lall, with us from the most powerful, authoritative global financial institution, the IMF, to address some of the key issues I just raised. Well, the policymakers and businessmen and academics in Korea at the moment pay really keen attention to the IMF economic forecast and the policy prescriptions. Plus, a lot of the Korean journalists and even Bank of Korea are waiting what you are going to say. Well, Dr. Lall is visiting to Korea for a regular step meeting with the Korean government. Well, I thought he might be here to negotiate to providing a short-term facility to Korean government, but that's not the case. Dr. Lall graduated from University of Delhi, India, with the first class with honors in economics in 1989, and completing his master's degree in economics from his alma mater, and finally receiving his PhD from Brown University. He joined the IMF as economist in 1996 and serving many key posts within IMF. He is the author of a number of IMF papers dealing with world economic as well as regional economic outlook. I look at this a long list of the publications. One piece really caught my attention. His co-edited book called Derivative Product in Exchange Rate Crisis, published by the Cambridge University Press in 1997. Did you, Dr. Ra, predict in your book the catastrophic consequences of repackaging of the endless derivatives based on the subprime mortgage in your book?
No.
Well, ladies and gentlemen, without further ado, please welcome Dr. Ra to the podium.
Thank you very much all for making it here so early this morning. I know it's very early to be out for any kind of meeting. We have the benefit of still suffering from jet lag because we came from Washington only a few days ago. So we are actually awake at 4 o'clock in the morning, so this wasn't very difficult for us. Thank you, President Lee, for inviting us to this presentation, and Dr. Ahn for that nice introduction and to set the stage. What I'm going to talk about here is the global developments and the regional economic outlook, and this is based on the last exercise we did on forecasting global, regional, and country growth at the IMF in November. But I will also try to give you a little bit of a background on the overall picture, the story that is emerging. There have been some more recent data releases, especially in US and Europe, for example, and trade data as well. So to give you an idea of what we see as the main patterns and the main risk factors for the outlook going forward. And then I'll conclude by talking a little bit about the prospects for Korea and what the implications of these global developments are for Korea. So the first thing in this slide, what you can see is, as you know, the financial crisis really started last year in July, middle of the summer of 2007. And it has gone through several phases. The first phase was somewhat localized. If you recall, equity markets were not affected, and in fact, many of them reached their peaks in October of 2007, several months after the crisis began. But then things took a turn for the worse early this year, and culminating at the time of the collapse of Bear Stearns. And then things were somewhat quieter in the summer, and then again, what you can see, for instance, in the chart there, and these big spikes which are associated with the collapse of Lehman Brothers back in September. So since then, and this was exemplified by stresses in interbank funding markets, which you can see in the first chart there, bank CDS spreads, which is a measure of credit risk of banks, but also high grade spreads. And so, and even if you look at emerging markets, the sovereign MB, you can see the spike in those spreads. So it's been quite unusual. This is certainly a very big financial shock, and it's very global. And some of them have characterized it as, for the US, the biggest financial shock since the Great Depression. But since September, by and large, things, and there has been forceful policy action across a number of countries, both in terms of liquidity injection, monetary policy, and also talk of fiscal policy, and that has improved sentiment, and you can see that in these charts, slightly improving conditions, what we would characterize as back from the brink, but clearly nowhere near being normal yet. However, at the same time, the focus in some sense has shifted from the financial markets to the real economy in many countries. And so you can see that in business and consumer confidence, which are in multi-year lows, in fact, in some cases, 20-year lows. And so you can see that here for the euro area, the United States and emerging economies, manufacturing purchasing managers index, which is a good indicator of where investment in manufacturing sector is likely to be. So they show a contraction, and then you see consumer confidence on the right chart, which is also low by, in fact, the lowest it's been for the United States in the whole period that we are looking at in this chart. So based on these developments, the IMF's World Economic Forecast predicts a major downturn in the global economy. And you can see that in our projections for 2009, where global growth is projected to be 3.7% in 2008, but only 2.2% in 2009. And then there's expected to be a recovery after that. And you can see that advanced economies are having a much sharper downturn than emerging economies, and I will come to that in a few minutes. But in fact, in advanced economies, you can see there is expected to be overall negative growth in 2009. In addition to that, the risks, and I'll discuss some of the risk factors in a few minutes, are firmly on the downside, which means that this is a very difficult time for the global economy, and the focus has, of course, shifted now from the financial sector to its impact on the real economy, and then feeding back to the financial sector. So what we have for the advanced economy is something like a U-shaped recession. So with, as you can see, negative growth in the US, the euro area, the UK, and even Japan in 2009, before a recovery takes hold in 2010. And certainly growth is expected to be a lot lower than potential in each of these regions, so it's very much a synchronized downturn. Emerging economies are also expected to slow below trend, and especially given the very strong growth in emerging economies between 2002 and 2007, which was one of the best continuous growth rates since the early 70s for many countries in the world. This is quite a striking turnaround in performance, although if you look at growth rates, they are still high and on average much higher than in the advanced economies. Some regions are affected more than others, and you can see that in the chart. The rightmost, emerging Europe, for instance, appears to be facing the biggest impact of this downturn, and certainly emerging Asia has is expected to maintain the highest growth among all emerging and developing country regions of the world. Now, the argument has been made before that emerging economies have decoupled, and somehow the economic prospects are not linked to that of the advanced economies. And we looked at that question in some detail, and based on our own projections. And if you look at the left-hand side chart, it is true that the growth seems to be diverging, not decoupling completely. But the fact is the underlying trend growth rate is actually higher for emerging economies than for advanced economies. So on the right-hand side, the chart you see is looking at the deviations from trend of both emerging and advanced economies. And then you see, in fact, that their prospects move very closely together. So the overall divergence that you see does not mean that emerging economies are not affected by what's going on in, say, the G3. It is very much affected, and in fact, it's quite closely synchronized if you take away the underlying differences in trend growth rates. So, in summary, what we see is going forward, given that the financial sector issues have still not been resolved, there's still a lot of uncertainty, credit conditions continue to remain tight, and as Dr. Ahn mentioned, one of the 3 Ds, deleveraging process, which is expected to continue for a while. There's going to be a slow recovery. So this is, as I mentioned, a U-shaped recovery in advanced economies, and this will, of course, affect emerging markets as well. Not a V-shaped recovery as we have seen in previous recent recessions. So we anticipate that financial conditions will stabilize, but there's still significant uncertainty around that. And as you know, every few weeks, there's new news, and under these uncertain conditions, it's very hard to project how soon financial conditions will stabilize in spite of the forceful policy actions taken across a number of countries. There is certainly greater resilience in emerging market economies, as I showed you, without both the growth projections and the underlying trend growth. But there are vulnerabilities in some, particularly those countries that are heavily reliant on external financing and, for instance, have larger current account deficits. They are vulnerable to a turnaround in capital flows. Inflation has been subsiding quite rapidly, and you've seen central banks in many countries and regions cutting rates quite aggressively. And in fact, oil prices now have fallen from above $140 a barrel back in July of this year to somewhat around $40. So that is bound to reduce the pressure on inflation coming from oil prices, particularly in oil importing countries. And now the question is, given the weak prospects for growth and contractions in many sectors, are there deflationary risks? More recently, since our baseline forecast, which is what I'm talking about today, and which is less than a month old, I think, there has been recent data that has been extremely weak. Now, according to the National Bureau of Economic Research, the US has officially been in recession since December 2007. Business surveys in the G3 economies have been extremely weak in November of 2008. And activity is weakening in emerging markets, and especially weaker trade. And that's true across the region. We've seen export numbers even in Korea for November, and then I think this morning there was from a few other releases and indicators from China. They suggest general weakness in the region and in emerging markets more broadly. But there have been some offsetting factors, so the news is not all bad. Monetary policy has been eased aggressively, and you saw the concerted actions taken just last week by a number of central banks across the world. Central banks have also injected liquidity to ease credit conditions in financial markets and used sometimes unprecedented scale of interventions and very unorthodox tools to try to improve liquidity conditions in markets and try to offset a credit crunch. Fiscal policy is also being contemplated in a number of countries and in fact across the globe. And certainly the IMF has been advocating that for many those countries that have the room for fiscal expansion to limit the downturn and limit the scope of the downturn that we see in the economy. On the plus side, also, oil prices have fallen sharply from their peaks in summer, putting more money in the pockets of consumers and reducing the costs for many businesses. So that's certainly something that is on the plus side. One thing, though, and this is based on a study that I did with a couple of colleagues in the summer in the World Economic Outlook, what we do find is that when there's a financial crisis that affects the banking sector, economic downturns that follow tend to be larger and deeper. So in some sense, now that the economy, the global economy and banking systems in many countries have been hit by this shock, it is unavoidable that there will be a downturn then, and this is consistent with the forecast. I just wanted to show you that based on empirical evidence, we looked at 117 episodes of financial stress in the last 30 years across all advanced economies. We find that financial stress, when it hits the banking system, produces deeper downturns and longer downturns. So our forecasts, which show kind of a U-shaped recovery, is consistent with past episodes of financial stress, especially those where banking systems have been affected. The deleveraging process will, of course, why do we care about deleveraging? Because it reduces credit to the economy, and it reduces the credit available for investment and also for households and for the housing sector. And so the deleveraging process, when banks and financial institutions shrink their assets while maintaining, trying to shore up their capital, is likely to reduce lending to the rest of the economy. And so the projections are for quite a sharp reduction in the availability of private sector credit growth in the US and in the euro area. However, credit is not a precondition for a recovery. And if you look at, this is based on past 3 recessions. In fact, GDP growth can recover before household credit and corporate credit resumes, but only for about a year. So eventually the credit process needs to start recovering again. But getting credit flowing again is not a precondition to having a recovery. This is just to give you a little bit of background to the projections we have. Finally, just a couple of more things on the global picture. Inflation pressures, as I mentioned, are receding fast, and that's partly because of the slowdown and certainly because of the easing pressure from oil and commodity markets. But emerging markets have been, as you well know here, increasingly affected since mid-September because of this financial crisis. They were relatively shielded in the first half of 2008. And in the left slide, you can see that there has been some differentiation in terms of impacts. Countries which have a bigger than 5% of GDP current account deficit have seen their spreads widen much more sharply than countries with smaller current account deficits or even surpluses, which means that there's been some differentiation based on the need for external financing. And again, as you can see, and Dr. Ahn alluded to that, equity prices have fallen across all emerging market economies. And this has certainly been quite a remarkable sell-off in emerging market equities in the order of 40 to 60%. To give you a historical perspective on this financial crisis, if you look at the US on the left side, interest rate spreads are much higher than they have been, at least in the last 10 or 12 years, including for AAA borrowing and, of course, for US high-yield credit. In emerging markets, what you can see, which is on the right-hand side, is that sovereign spreads are not as high as they were, say, at the time of the 1997-98 emerging markets crisis. But corporate spreads, and the corporate market is a relatively new phenomenon in emerging markets in terms of large-scale access to international bond issuances by emerging market corporates. That's definitely risen very sharply from when the market really took off in the early 2000s. As I mentioned, that in general there are reduced vulnerabilities for emerging markets, but not for all of them. On the left-hand side, you see in general that external debt has declined and reserves have increased, and current account deficits are in generally much better shape. But if you look at one example, which is emerging Europe, the picture is slightly different, and certainly that might explain to some extent why financial market pressures are somewhat higher in emerging European countries and the growth prospects are lower. What does this all mean for Asia? Asia is a very open part of the global economy. It has strong trade linkages with the rest of the world. And clearly what happens in the advanced economies is going to have an impact on Asian countries, because the linkages, if anything, have grown. Although intra-Asian and intra-emerging market links, trade links in Asia have been growing over the past decade, and especially in the past 5 or 6 years. It is not realistic to think that what happens in, say, Western Europe or the United States will not affect Asia. This is also true for financial markets, including equity markets. When there's large foreign investor participation in these markets, it is bound to affect all the markets in the region just because of greater integration of capital flows. So this, we project growth to slow quite sharply in Asia next year. And then, but still, if you look at, say, for instance, emerging Asia, growth is expected to slow from 7.7% to 6.5%. And in Korea, we have been projecting growth to slow from 4.1% this year to 2% next year. Because of the decline in trade, most of the growth next year we anticipate in Asia is expected to come from domestic demand, including consumption and fixed investment. The contribution of net exports will be, in fact, slightly negative next year. However, this is our baseline forecast, and this is it's about a few weeks old, and in the current environment, things change very quickly. So our risk to the forecast is certainly to the downside, because there are a number of things that remain matters of concern. And of course, in addition to growth prospects, and I mentioned a few of them, trade seems to be declining quite sharply across many countries and regions, and certainly that affects Asia. The prospects for growth in the US and Euro area will need to be revisited depending on incoming data over the next few months. Of course, there's also some uncertainty about policies, and on the upside, some kinds of policies could help improve to limit the downside. But overall, and financial market uncertainty remains, and that's in some sense tied to prospects for the US housing sector. In some sense, you could say that a lot of the crisis was related to the US subprime market, and until the US housing market bottoms, it will be difficult to say that the financial crisis is definitely behind us, because the markets need to find the floor, asset prices need to find the bottom and then recover. So that's one of the main risks on the downside. And for Asia, what slower growth and the slight tighter funding conditions are doing they are putting pressures on the non-financial corporate sector. What you see on the left here is local corporate bond issuance, but in fact, if you look at overall borrowing, the picture is more striking, that there is banks and financial institutions are becoming more cautious, as they are everywhere in the world in this uncertain environment, and so funding conditions appear to be tightening for corporates, and so this is likely to have an impact on our slower investment next year. But the vulnerabilities differ across countries in the region, and in more generally, they depend on whether countries have current account deficits, how much the domestic financial sector relies on wholesale funding, including by banks, how much foreign participation there is in domestic equity and bond markets. In other words, how quickly money can leave if investors panic or there's some development in the advanced economies that is affecting risk perceptions in their home markets, and so they need to pull out from other markets. And then corporate balance sheets are, of course, very important, because if funding conditions tighten abruptly, how long can corporates manage by relying just purely on internal financing and retained earnings? And countries which have greater domestic macro imbalances, including, for instance, a very large debt burden or inflation, will be more vulnerable in this uncertain environment and in this environment of extreme financial stress. And some countries have property sector booms. And of course, in the US, there has been a downturn in the property sector. In Europe, many housing markets have also risen, and some of them actually at a greater pace than in the US, but they seem to follow it down with a lag. So one could expect that to be the case for other, even emerging markets where there's been a very large property boom. And of course, lower commodity prices matter for commodity exporters. Their export earnings would suffer and make them more vulnerable. On the other hand, it does benefit commodity importers. So how are all these developments? I've painted a picture of the global economy, which perhaps might come across as a little grim, both in terms of growth prospects and the financial market background. So how is this affecting Korea? So Korea consumption has certainly been trending down for a while now, and the most recent data continue to show continuation of that pattern. And you can also see, of course, equity prices have been falling, and so these indicators of consumer spending are trending down, and investment activity has also been slowing for some time. Construction orders have certainly been shrinking, and as have been machinery orders, and bank credit to small and medium enterprises has been slowing. More recently, the export numbers, which had continued to be very strong in the first half of the year, seem to show some weakness, especially in November. The export numbers and the import numbers were very weak, and this is in some sense symptomatic of a more general weakness in global trade across the world. And you can look at other indices of global trade and shipping, which are consistent with this view that global trade appears to be slowing quite sharply. And in the case of Korea, this is also true of trade with China and other non-traditional markets whose share had grown quite rapidly in recent years. And their trade has also, trade to those destinations has also been falling. So in general, measures of economic activity are decelerating rapidly. Industrial production, as you can see, has been shrinking, and at the same time, inventories to shipments are rising, which means that perhaps not all the goods are moving. So, and business confidence, which is another good leading indicator of growth, is at a 10-year low now. So overall, all the indicators are pointing to a slowing of the domestic economy and a slowing of global trade, which of course also affects Korea. As a result of that, our baseline projections, what we have here is, I gave you the headline number earlier, is of 2% growth in 2009. And this means that growth basically bottoms out in the first quarter of 2009, and after which there's a gradual recovery in line with the projected recovery in the global economy and in improvements in global financial conditions. At the same time, because of the slowing of the economy and reduced pressure from commodity prices, we expect inflation to return to the target band of the Bank of Korea in early 2009. So inflation pressures, headline inflation is already easing because, and of course, as I mentioned, oil prices have fallen. Core inflation is still trending slightly higher, but is also expected to follow soon. And the current account should swing back into surplus in 2009, again helped by the easing of oil prices and the softening of imports and the depreciation of the exchange rate this year. So what are the key messages overall? Certainly the global downturn is deep, and we expect the recovery to be very gradual. The financial crisis itself will have a protracted impact on the advanced economies, and our own empirical studies have shown it takes time. The downturns related to financial stress are much deeper and tend to last longer, and this certainly has been one of the biggest episodes of financial stress in the last 70 years. Emerging economies have not decoupled. They cannot decouple in an increasingly integrated world. But the underlying trend growth rate still continues to be higher, so the slowdown in activity overall in emerging markets will not be as big as in the advanced economies. Growth in Korea is definitely slowing, but it's expected to recover by mid-2009, with the current account returning to surplus and inflation receding. I should also mention that questions are asked about the financial sector in all the countries and how the crisis is affecting them. Banking system fundamentals appear to be sound here, but as in other countries, looking forward, what everybody is focusing on, policymakers are focusing on, and of course markets are focusing on, is the feedback loop between the real and the financial sector, which is once the real economy slows and if that affects asset quality and feeds back to the financial sector, which leads to reduced credit and then slowing the economy further. That's one of the main questions in many countries going forward. So this is our baseline forecast, but as in the global economy, the risks are firmly tilted to the downside, given the range of uncertainties in the outlook, including growth in partner countries, how soon the financial market conditions will normalize or more or less normalize. When will the deleveraging process stop? How soon will the US housing market bottom out and start growing, which is at the core of the stabilization of global financial markets. And when will global trade recover? So there are a lot of uncertainties, and policy actions are being taken, but a slowdown in the global economy is unavoidable given the size of the shock that has hit the global economy. So, as I said, risks are still very much tilted to the downside. I'm going to stop here and certainly be very happy to take some questions. Thank you.
As you know, well, the IMF has the most sophisticated econometric forecast model, and with also most reliable comprehensive database in the world. So what he predicted should be most authoritative. He answered some quick questions I raised. Number one, Korean economy forecast to grow 2% next year, and economic recovery will bottom up by the end of the first quarter next year, and Korea will continue to be coupled with the economic recovery of advanced economies and the world and so forth. So we need to finish up the Q&A session around 8:25, because he has another important appointment. So let us use our precious time to the maximum advantage.
I always experience that forecast is better done by the local economists than the international economists that the foreign countries. So I believe that Korean economy can be predicted better in Korea and USA. You said that I think that you are too optimistic on the growth prospect and the current account prospect. The Korean economy has just plunged into the very low level activities. The next year, I will feel that there's a real restructuring, industrial restructuring will start, and a lot of and now the export just began plunge. It can become very suddenly drop. So I think that this recovery will become far slower, probably end of next year or end of next year probably. And then next year, this current surplus seems to be too optimistic. Now they think about the Japan, USA, and EU. They are becoming worse and worse. So the Korean manufacturing companies will try to produce as much they can, because they should maintain their employment, current employment. So their production will go on, but they try to import. They cannot export much. So what I'm saying, the import will be, will not become much, but export will be far slower. So I think that surplus is very difficult. Thank you.
Well, I mean, you make a lot of valid points, and certainly I agree that the prospects for the Korean economy are closely tied to that of the rest of the world. I should mention that the baseline forecast and the whole exercise we did was actually about a month ago now, and developments are changing by the week, and we are in the process. And of course, part of the reason we are here is also to get a better understanding and a feel on the ground of what the prospects are. And as I mentioned, though, and I think the way to put your remarks in context, I did mention that the risks are still firmly to the downside in our projection so far, and we will, of course, be updating as developments and data come in. But at the moment, that's our baseline, and certainly we are aware of many of the risks, including from a sharper slowdown in the US and Europe. So our next round of forecasts will reflect all that is happening now and will happen in the next couple of months. And so it's also a very difficult time to make forecasts because of the great uncertainty, and certainly because of the linkages between the financial and the real sector, and the financial sector developments change on a daily basis. So as a forecaster, this is a very difficult time to come up with something that'll stay stable for a long enough period of time. But thank you for your remarks.
Okay, I have one question raised from the floor. I submitted in a given format from Seoul Medical Consulting, Sujin Hong. There's a really serious, bigger and the crisis in the U.S. housing market, far bigger and serious than the subprime mortgage. If U.S. housing prices keeps go down, and this is really worrisome prospects. We should address this issue straightforward. And what do you think the U.S. government, or for that matter, U.S. Federal Reserve, will take action if U.S. housing market does not recover, if the price of the housing market just keeps going down?
Certainly, the U.S. housing sector is a very important sector, and it is a concern. When will it find bottom? There have been the recent indicators. There's been some signs of positive signs, including, for instance, that refinancings are rising. Of course, new home sales are still weak, but part of the reason is, again, it's because of the financial crisis that even though policy rates are low, the spreads on mortgages haven't fallen as much because of the risk aversion of financial institutions. And certainly, we'll have to see. I mean, policy measures are being contemplated to reduce the spread again on housing and mortgages, and that is likely to, but it will take time. And once those measures are implemented, I mean, there has been discussion in the press, for instance, of further measures to boost lending by Fannie Mae and Freddie Mac, and if those reduce the spreads on mortgages, it's very likely, I mean, the market is very flexible, so it's likely to boost buying and purchases of homes and bring a floor to the housing market. Of course, there's great uncertainty about when that will happen, and financial market conditions need to be stabilized for the housing market to recover.
One magazine recently described as Citibank incident as latest unthinkable rescue of very large institution, and I'm very curious about when this financial crisis will be finally over. That is my first question, and my second question is that now with this financial crisis and economic recessions going on parallel, and that with financial crisis, now there is a liquidity gap, and the US dollar is being really was appreciated. And now with curious economic recession, that US government is really pumping money, then eventually that my curiosity is that eventually that US dollar should be depreciated. And do you agree with this? And if that happens, when this US dollar will start to depreciate? Thank you very much.
When will the financial crisis be over? I don't know. I don't think anybody knows because there is uncertainty, and a lot of it is, of course, also linked to sentiment in the market. So I think, when will investors decide that, it is valuations have reached a level where they feel safe coming in. So our projections are that the conditions will continue to stabilize and improve, but the process itself is drawn out because the deleveraging process itself can take 1 to 2 years. It's not 1 to 2 months. So it's hard to define when you say the crisis is over. In many ways, I guess one definition would be when does normal credit resume, and certainly our projections are that the markets will turn around by the end of next year. I mean, the credit process will resume and then gather full steam by 2010. But as I said, there's always there's new news. You mentioned yourself an example. So it's very difficult when you're in the middle of a crisis to call an end to the crisis, and certainly anybody who can successfully do that would be very rich. But I think everybody is groping in the dark here. Now, on exchange rates, as you know, I mean, as economists, we really have a very hard time predicting exchange rates and the factors that affect major exchange rates, for instance. The only thing I would point out that, yes, the US is pumping in a lot of liquidity, but then even other central banks around the world are doing their best to pump in liquidity and shore up markets and make sure that the credit transmission mechanism does not break down. So it's very hard to look at that factor alone and make any conclusions about the impact it's likely to have on the exchange rate. But beyond that, I don't think it's appropriate for me to comment on major exchange rates going forward.
Well, in fact, I have one question raised from the floor on the very issue of the exchange rate, your forecast. I think that your answer should be sufficient enough to address this question. All right, let me ask this question. Really, the Korean exchange rate is volatility and the rampant rise has been the main cause of many Koreans, worrisome prospect for Korean economy. So to resolve this, first we utilized foreign exchange reserve. Now we are hitting, about the $200 billion level, all right? About the 3 months period from the $240 billion. And we thought this U.S.-Korea currency swap agreement helped us to relate this issue. And then we do have also IMF short-term facility, which you are able to draw if you wish, about the $22 billion. And then now Korea is proposing to expand a multilateralization of the Chengman initiative, expanding the currency swap up to $80 billion. You think this should be enough to handle the external shock to maintain Korea's exchange rate to return to a normal level? Or do we need to add some defense line?
It's actually an interesting question because, certainly all the measures you mentioned, there's a lot of firepower available. And even, if you look at, this is a very tricky question to answer, but part of it, the depreciation happens. There's a global deleveraging process going on. And this is happening worldwide that, banks, financial institutions, they're contracting lending and then they're pulling out of the more liquid markets where they can. But certainly if you look at the numbers in terms of, even foreign participation in the US, in the Korean markets, and in terms of external debt, Korea's external position is very comfortable that way. So, there is, and including, all the things, there is a lot of firepower. Some deleveraging adjustment in the exchange rate is inevitable in this process because of what really is happening in the US and in Europe, and that's the natural, the financial system, if you like, globally needs to shrink a little bit, and so money needs to flow out a little bit, and so that the financial institutions in Europe and the US can get to the leverage ratios they want, and not just financial institutions, hedge funds and others as well. So, there's the underlying conditions. So what I would say is that the depreciation that has been seen in this and in other currencies is part of the natural deleveraging process, and in that sense there's nothing completely alarming about it, because we see that in every country where there has been these kind of channels at work.
I'm a reporter of 중앙일보. My name is Jang Jae-hong. Recently, Korean government proposed to invest infrastructure a lot of money to rescue the economy. But there is a controversy whether infrastructure investment is good to Korean economy. What do you advise for Korean government to revive its economy?
We are still actually very much in the middle of our visit here. We've only been here 3 working days so far, so I think it would be too premature for me to make any observations on policy advice or on as I said earlier, we are still doing our diagnosis. And we are trying to get a feel on the ground and certainly talk to our counterparts. So I'm afraid I don't really have anything to say at this stage. It's very early in our process for us to have. We're still in the process of informing ourselves and forming our views on policies, and I don't really have anything to add to that right now.
In mid-November, we had the G20 meeting in Washington, D.C., and Korea now serves as co-chair with the UK and I believe with the Brazil. And Korea can play a very significant role to provide foreign exchange, the facilities to emerging economies. You think this Korea can play a very effective role at the G20 meeting and even the designing a new architecture, it is implementing the monitoring and front corrective actions, then IMF, the G20 process?
I mean, certainly there's no question that Korea is one of the most important economies in terms of size and influence in the global economy, and and yes, I mean, it is playing a welcome and very important role in the G20, and certainly I think that this will be it's a very constructive and a great opportunity to follow through on some of the main proposals that were discussed. I mean, it's a longer-term process, of course. So the summit last month was, in a way, the beginning of the process, and certainly I think the G20 and more generally the policy community is looking towards Korea in playing an important role and providing important guidance as the process moves forward, although it's a long process.
Do you think, I mean, one of the reasons we had these big liquidity problems and excessive risk-taking in the United States was the imbalances. And we've seen the IMF struggling with this problem for 20 years without being able to resolve these sort of macroeconomic issues. And I wonder if in the future we'll be able to see some improvement, because I think if we can't convince our respective public that we've done something about this to prevent it happening again, then of course we'll have failed at some level. What would you say about that?
Has happened. I mean, I've seen there are a range of views on what led to this crisis, and certainly, the imbalances of one kind or another. I mean, people have very influential people have been looking at saying, well, part of it is because of excessive consumption in the United States, and others have said it's because of the global savings glut. Another view is because regulation was lax. And then a related view was, well, interest rates were so low, what could we do? We had to buy risky stuff to make money. And then the development of derivatives markets. So I think it's, it's clearly, it's still early days. And as I said, we're still in the middle of a crisis. So I think it's probably important to put the fire out first and then think about how to revise the fire code. So, and there will be, I'm sure, a lot of debate, and certainly it has served in many ways as a wake-up call in terms of how, if you like, the financial architecture, and certainly, I mean, there are measures underway, and I do believe there will be constructive suggestions coming out of this, but at the moment, the priority is also, of course, to try to put this crisis behind us, and will there be improvements? I'm actually confident there will be, and I'm extremely confident that the important lessons are being learned, and including by us, and will be learned from this crisis. But it's important to keep in mind that we take all the factors, all the arguments into account, and then come up with something reasonable. And you certainly don't want to throw the baby out with the bathwater. So, but this is something which will be discussed, and expect that many PhD dissertations will be written on this crisis, and books will be written as well. So there's a lot to learn from this for everybody, and with an open mind.
Okay, before closing, final question. In the last 2 or 3 months, sometimes international press, they painted the Korean economic outlook, really in a miserable way, pointing out that Korea might run into another international liquidity crisis. Sometimes those reports from international press based on the distorted data and wrong information. Since you are the IMF experts relying on most accurate database, whenever this occurs, can you correct those international depressed treatment on Korean economic assessment?
Well, we try to because we do come out with our as you know, the forecast for the Korean economy comes out at the same time as the World Economic Outlook. It used to be twice a year. Then we did it 4 times a year. Now it seems we're doing it every month or so. So we do try to be as transparent and open as possible in our assessment. And I agree with you implicitly what you're saying, which is it's very important to have to speak objectively about these things. And I mean, of course, as in any country, I mean, there are things that it makes a good story sometimes, to make a very dramatic picture on something. But we do our best. We are always very open. I mean, this presentation, this is what I talked to you about, was from November. We'll have another one in January, then we'll have another one in April, and so on. So every few months we are updating, and we are trying to play as constructive a role as we can.
Thank you very much. As I said, Korea is really IMF reform model. Okay? And I think the IMF should be proud of this, what Korea has accomplished in terms of restructuring its overall economic system. So in this regard, I think the IMF is a truly good friend of Korea, and we hope you continue to provide us your accurate information, and also furthermore arranging the international external economic environment in favor of the Korea's recovery path. Thank you very much. Please join us. Please share your attention.
Thank you very much. Thank you, Dr. Thanks very much.